This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Okay, welcome everyone. I hope you had a good break over the Christmas New Year period and all the best for 2025. It's great to be back. Good to see you again, Deanna. Hope you're well.
Yep.
Thank you. I am pretty well, thanks. Anyway, I was just thinking about markets. It's actually been a reasonably good start for investment markets so far this year. After a pretty strong 2024, I think the big surprise through 24 was just how strong things were, even though we had that bit of a dip at the end of the year. But so far this year's been reasonably good. How are you seeing it?
Well, apart from that week or two period where we had that increase to bond yields, the US 10-year nearly touched 5%, I think, over concerns about higher US inflation, higher US tariffs coming through with the new administration, and then also some concerns about the debt ceiling issue, which the Treasury will need to come up with some additional funds somehow, or to sort of change some of their spending measures to fund the government basically for the next few months until they reach the debt ceiling. That did cause some short-term downside to share markets, but since then really we've seen some quite positive news on the economics front, and lower bond yields have been positive for shares. Yeah,
it seems to me like there was this nervousness going into Donald Trump taking over, and part of that nervousness was set off by the Fed at the end of last year, which suddenly seemed a little bit more hawkish than
it was
they
a
were.
Hawkish hike. Sorry, it was a hawkish cut.
It was a hawkish cut. There was a guy the other day asked me, you write in your notes hawkish and dovish. What does this mean? And maybe we should explain that. But hawkish means, I guess, where a central banker has an inclination to raise rates. So their comments are sort of heading in the direction of raising rates, or maybe not cutting rates as much as previously indicated, which is sort of where the Fed seemed to be at the end of last year. Dovish, of course, means the central bank is heading towards cutting interest rates or leaning in that direction, or maybe not hiking as much as they previously were talking about. But it seems as if with Trump coming along, markets have settled a little bit. But obviously that's been the big news so far this year, with Donald Trump taking over, very entertaining inaugural address, lots of debate about who was wearing what and who made funny looks and all those sorts of things. But what's your interpretation so far of Trump?
Well, it sort of looks like markets have priced in everything, high US dollar, high US bond yields. And since the inauguration, actually, yields have come down a little bit, share markets have gone up. So maybe all of that pricing for Trump has already come through. I mean, I think that there's still likely to be some further downside to shares because we haven't actually seen any new policies announced from the administration. He signed I think just under 100 executive orders when on his first day, but they were mainly all around energy, so more drilling for energy in the US, and also around border control. So he wants to tighten the borders and also to actually deport some people, especially on the southern end of the US border. So no real news on tariffs or taxes, which are the two main policies that will actually have the biggest impact to share markets and to bond yields. And we haven't actually seen anything on that. There was some announcements on Bloomberg that Trump said he would start to look at the 10% tariff on China and the 25% on Canada and Mexico, which he announced he would do last year, that those would start on the 1st of February, but they haven't actually been a policy that's been enacted. So far, we don't actually have any new policies, but those will come about, I think, in the next few weeks. And when we do get those announcements on tariffs, I assume that the short-term impact to share markets would be to the downside. And I guess we have to wait to see how large those tariffs actually are. And if it's an instant 60% on China, then that would have quite a negative impact to shares. And some commentators are suggesting that Trump's actually likely to go hard straight away rather than to do these incremental increases. That sort of seems to be where his administration is leaning to. So that could actually have quite a negative impact to share markets. But at the same time, if we still have an economy that's growing pretty well in the US and a Fed that's still going to cut interest rates, albeit not as much as they maybe could have this year, I think that still sets up a pretty positive environment for the US economy, even despite these short-term downsides through tariffs.
Yeah, I'd sort of agree. One thing that worries me about the return of Donald Trump is that my son has brought back the jokes about my hair looking a bit like Donald Trump. he and I were watching the Apprentice, the new movie about Donald Trump, or his formative years, and my son kept going through. Oh my God, he combs his hair the same way you, Dad. You like that flick round the side here. One scene there, Donald Trump's looking in a car window to try and adjust his hair. He gets out of a car, long Cadillac, and my son's saying, "That's the kind of cars you like, Dad. You know, you're Trump all over." And I'm thinking, "Oh no, here we go again." But it seemed to me there was no great surprises from Trump. Yeah, on the one hand, it is a reminder, though, of the volatility that we have to get used to.
Yep.
That first day, his inauguration day, markets were closed, but other markets around the world could react. Sorry, the US market was on holiday. Other markets could react. Initially, I think markets took relief from the fact that there was lots of executive orders, all that sort of stuff, but nothing specific on tariffs. And then, of course, later in the day, that night, I think Trump comes out and says he's still thinking about 25% tariffs on Mexico and Canada, and suddenly markets think, oh no, he is still doing it. So, but that's part and parcel of the way Trump operates. I sort of get the impression that he'll say one thing and then wait to see the reaction to that. If he doesn't like the reaction, he'll then push it back the other way. And at the end of the day, Trump also wants to be a great negotiator. If you watch the film The Apprentice, where the term the art of the deal came from, he sees negotiation as something very enjoyable, something he really loves, and he sees it as artistic.
And to his credit, he was the X factor in the negotiations between Israel and Gaza. That sort of was agreed a few days before he actually took office. So we may see some more agreements around Russia and Ukraine.
It's quite possible he could play a role in sort of calming things down around the world. Of course, there's lots of different views on that. Some say that Israel gave in too early and that it was Israel who was fearful of Trump, and that may be to Israel's detriment in the long term, but we can go in circles on these sorts of debates. But in other words, if it is largely about negotiation and he's trying to get a better deal for America globally, stop the drugs coming in, stop the people coming in across the borders. And don't forget, we've done something fairly similar in Australia with trying to stop boat people coming through. And likewise with China. You could argue that could lead to a better outcome. I guess the problem for markets, of course, and I'm putting all the issues about Donald Trump's character aside here and leave that for other people to judge. But I guess the issue for markets is, as you intimated there, when you make the announcements regarding these things, whether it's tariffs, particularly on China, immigration, all these sort of things, it can cause volatility in markets. And I think that's just something we have to get used to this year. It is going to be a more volatile ride. And we in Australia will often be getting up in the morning to see what he said on Truth Social or X or wherever. And that can cause a bit of annoyance for some people, like myself, who want to have a quieter life perhaps. But volatility is just something we have to get used to, which sort of brings me to the Fed. I kind of get the impression that the Fed had that sort of slight hawkish tilt at or hawkish cut, as you called it, at the end of 2024 because they were wary of what Donald Trump might bring.
Absolutely. They even specified it in their post-meeting commentary.
They have. And I guess how do you think they would be interpreting what Trump has said so far? Do you think it would have much impact on them, or are they still going to proceed with 2 cuts as we go through 2025?
Well, given that we haven't seen any of those policies on tariffs, I think it's sort of too early for them to judge what actual impact on inflation any potential tariffs will have. I mean, it's obvious that tariffs are a certainty. Trump even said tariff is the most beautiful word in his dictionary. So it's sort of definite. We just don't know to what extent. And if we remember back to 2018, a lot of economists did overestimate the impact of the tariffs on inflation. I guess we did have the pandemic soon afterwards, so it was hard to judge absolutely what impact the tariffs had, but I do think that there was a bit of overestimation about the impacts of those tariffs. So for places like the central banks, like the Fed or the RBA, I think it is, or even for all economists, it is sort of difficult to make an analytical judgment about the extent of the tariffs and the impact to inflation and growth. I think from the Fed's point of view, there's still more room to cut rates, to normalise policy to more neutral levels and to support the economy, given that the unemployment rate has increased. But they can take their time with those cuts. And maybe we won't get a cut until June. It doesn't look like we're going to get a cut in the next few meetings anyways.
I mean, the good news was on inflation, and this was after the Fed meeting in December, the core PCE. I know a lot of economists love the term PCE. PCE is private final consumption deflator. It's another measure of inflation in the US. Anyway, the core version of that, and that's the one the Fed focuses on, obviously excludes food and energy, and it slowed to 0.1%, I think 2.8% at an annual rate in the month of December. And the CPI, which everyone was fearing about a week or so ago, came also in on the soft side of 0.2% at the core rate. So that's a good sign.
Yeah.
But obviously, as you say, a long way to go yet to get clarity around what Donald Trump will do. When I look around the world, it seems like we've got mostly good news. Inflation in the UK, Canada, I think New Zealand is sort of coming on the softer side, consistent with all of those central banks heading towards more rate cuts. We're probably going to see the ECB cut rates again in the week ahead, which of course then brings us back to Australia. We've got some big numbers coming up just after Australia Day in Australia with the CPI, December quarter CPI. It's the big one. We get these monthly numbers. They've sort of been okay. The November numbers were pretty good, I thought, for the trim mean or underlying inflation in Australia. Sort of looks like it's coming down. But obviously we got that CPI coming up Wednesday in the week ahead. And then, of course, that's the lead-in to the February RBA meeting, which this time around is delayed 2 weeks, 3 weeks perhaps, for some inexplicable reason. I can't quite understand. Maybe it's got something to do with the election perhaps, but it's not till February the 18th. But what are we expecting for the CPI when it comes out?
So based on some of the monthly data that we get and the volatile items that move like electricity and petrol, it looks like headline inflation will be only 0.2% over the December quarter, so about 2.5% or so year on year. But the more important one is really the trim mean, and we think that will come in at 0.5% over the quarter. Now
that's quite a bit less than the RBA's.
They've got about 0.7. Yeah, that's right. And if you annualize that, I mean, obviously that's at the bottom end of the 2 to 3% target band. Year on year, it still looks higher than that. But I think we should be annualizing things now on a quarterly basis because we've had so much volatility in the inflation figures. And what's more interesting is if you look at across the components of the CPI, the monthly data showed us that a lot of the service areas that the Reserve Bank had been worried about, things like new dwelling construction costs, insurance and finance costs, even some personal care services and rents, a lot of those areas have actually seen a slowing in inflation. And those were sort of the problem worry parts of the inflation basket. And given that we've now seen that slowing in services inflation at a time that goods inflation is not negative, but it has slowed quite a lot, that's quite a good news story, I think, for trim mean or underlying inflation. And if we get that 0.5% for the trim mean, it's hard to see the RBA not responding to that by cutting rates in February. Although at the same time, the labour market data that we had recently for December wasn't too bad. I actually think it was quite good. Jobs were up by nearly 60,000 over the month. The unemployment rate only increased to 4%, not 4.1% as expected. I mean, a 4% unemployment rate for Australia is still incredibly low. The lowest that we've ever had on record is about 3.4%. So do you think that even if we see...
Well, in recent years, I think if you go back to the 60s, we did get numbers
that's
below,
right.
a long time ago.
Yeah, a long time ago. Well before my time.
Well, within my time. When I was a little kid.
Do you think that if we get that weakness in the trim mean, but the unemployment rate is still at 4% or 4.1 even, would the RBA still be forced to cut rates now?
Well, that's the big debate. I mean, the RBA could say, well, we've got the Aussie dollar, which has had this fall from 69 in September to 62 cents against the US dollar. So there's that going on, and we got a still strong labour market, so there's no urgency to cut. I mean, the counter to that, of course, is the Aussie dollar is always quite volatile. It's just in the range that it's been in for 4 years now. If you look at the Aussie dollar on a trade-weighted basis, it hasn't fallen anywhere near as much. And likewise for the jobs figures, yes, unemployment is very low, but by the same token, we're actually seeing slowing wages growth. So you don't necessarily need to worry about the jobs market being this tight. So my feeling is that, yes, if we do get trim mean inflation of the order of 0.5, was it 3.2% annualised in the twos on a quarterly basis annualised, that it would make sense for the Reserve Bank to cut. So I'm reasonably hopeful that they will when we get to the February meeting. But obviously a lot depends on that CPI number. Before we wrap up, one thing sort of got me wondering, given the success of these meme coins, the one that Donald Trump's launched and then his wife the next day, and the billions that he's made out of thin air, this is something that didn't exist a week ago. Suddenly it does exist. It doesn't actually do anything. It just depends on hot air, like one of those meme coins out there. I think it's called Fart Coin. It is in fact called Fart Coin, depending on hot air rising. Maybe we should do the same thing. We should have a Shane and Deanna coin and encourage people to get on board and join in the fun.
This is not financial advice.
No, it's not. It's all crazy. But it's just an idea, just out of thought. Maybe we should all do that. If everyone in Australia can come with their own meme coin.
So if there are any listeners that want us to create a coin, please write to us.
So we could all do one. We could all become instantly rich, have billions like Trump has.
But he hasn't actually made any physical money on that. It's just the value of the coin has gone up.
Apparently his companies or whatever own 80% of it. If he decides to sell it, then it might flood the market with this funny coin, and the price could go back down again. So it's all a bit iffy in my mind. Anyway, just a thought.
But on to more concrete things for the year. Our view on markets, despite the volatility that we're likely to have with uncertainty over the number of cuts, Trump-related news, maybe some increases to US bond yields as well in the short term. Despite all that volatility, we're still positive on share market. Share market returns are likely to be about 7 or 8% on some of our forecasts this year. And economic growth around the world should also be quite solid, running at over 3%. And I think that the outlook for Australia certainly looks better this year, given that we're going to get some rate cuts and lower inflation, which is good for household purchasing power.
I think the key is it's probably going to be an okay year. Just allow that we're probably going to have more volatility and returns are going to be a bit more constrained than they have been over the last couple of years.
Well, that's it for this week. Thanks, Shane. See you next time.
Thanks, Deanna. By then we should be rich with that meme coin.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.